Hi folks, I'm Bob Benny.
I'm Jessie Thompson.
And we're both certified financial planner professionals, CFPs, with Bob Benny Wealth Management right here in Lincoln, Nebraska. And welcome to today's Bobcast. We do these weekly Bobcasts. What's the topic today, Jess?
Today is proactive strategies for down markets. So we came up with this topic because the market has been down a little bit year to date. And people always wonder. But
it went down a lot, and then it's kind of come back a lot in the last few days. So this topic may be irrelevant if it just keeps coming back. I don't know.
But it is relevant because this is very normal. This happens every year. Almost every year there's a drawdown of some severity. And whenever that happens, people always think, what should I be doing differently? Or what can I do about this? So we're going to talk about some proactive strategies of what you can do, because last week we talked about what you should absolutely not do. And the things you should absolutely not do is get out of the market.
Yeah, the number one thing is don't get out of the market.
Move to a more conservative allocation. That is not the time to do that in a down market. So here are some better things that you can do.
So the number one, the first one that we have, is to invest cash that you have on the sidelines. If you have some excess money in the bank, more money than you need for a rainy day fund, say 3 months living expenses or whatever, it's a great opportunity when the market's down to take advantage of the sale that they're having on stocks. So invest cash on the sidelines is number one. What's the number two one?
Number two is Roth conversions. When the market is down is the perfect time to do a Roth conversion. A Roth conversion is when you take traditional IRA money and you convert it to Roth money. So IRA money is money that you've never paid taxes on before, and Roth money is post-tax money. When you do a Roth conversion, you're taking IRA money, putting it in, transferring it to a Roth. You have to pay regular income taxes on the amount that you transferred from the traditional IRA to the Roth. But the awesome thing about Roth conversions is that money then grows in the Roth tax-free, and when you go to take it out, you don't have to pay any taxes on it.
Right.
So when you do that on a down market, the amount that you are taxed on is going to be lower because the market's down. But then when it goes into the Roth and the market returns, all of that growth is going to be tax-free. So
if you have questions about that, please contact us. Call the office or email us at bob@bobbenny.com or jesse@bobbenny.com. But when the market's down, is a great time to do a Roth conversion. We know how to do this. We've helped people take advantage of this, and it's been a great deal for them in the past. The third proactive strategy in down markets is to, for lack of a better word, offload unwanted holdings while capital gains are low. You may have some stuff in your portfolio that you aren't that great, that you're not that thrilled with, but you can't sell them or you don't want to sell them because of the capital gains. Well, when the market's down, if that stock or mutual fund or ETF is down, it might be a good time to sell them and so that you have less capital gains to pay taxes on when the market's down. So what's the last one that we have, Jess?
The last one is three-part, and it's rethinking your retirement income plan. So if you are retired, that's usually when people get the most freaked out about down markets because they're taking money out.
Maybe the word is not necessarily rethinking, but maybe making an adjustment in your retirement income plan.
A strategic adjustment. So the first thing that you can do is take income from a different source. So if you are taking monthly income from from your investment accounts and the market is down, but you have extra money in the bank beyond the 3 months of expenses that you need to have in there, switch over your income to be taking your monthly needs out of that bank account that's not down right now and also not working for you, rather than taking it out from your investment account while the account is down. Right.
Another one would be to just overall reduce your withdrawals if possible when the market's down. That's going to make it so that your account will recover better when the market comes back up if you reduce your withdrawals a little bit, if you can a little bit.
And the last one is minimizing large purchases. And so if you can adjust the timing of when you need to make a large purchase and take large chunks of money out of your investment accounts to do it when the market is not down, That's the
Yeah.
best.
You know, like for instance, if a customer comes to us and they're wanting to buy a car, and they've have plenty of money to buy a car, can totally afford it, that sort of thing, it might be wise at that point, particularly when the market's down, to finance the car rather than take $30,000 out of their IRA while the market's down. Rather, finance it. They can always pay it off fully when the market comes back up. Those are just some ideas, some different things that can be proactive strategies for down markets. But we just want to impress on people that you're welcome to call us or email us and ask questions about things to do in your particular situation. We want to help people. God put us here to help you, and so please let us know what we can do.
Thank you very much. Make sure you like and subscribe so that you get more of this free educational content, and share with anybody that you think this would be helpful for. Hope you have a great week.
Thank you. Bye.